thank you very much for staying here and listening to us talk about private credit. What a topic, right? It's really had some explosive growth over the last couple of years, all the way up to just over $2 trillion. And it's not showing any slowing in its pace. People projecting it to reach, upwards of $5 trillion in the next 5 years or so. So it's fantastic. There's a couple of interesting topics we're going to explore here with these geniuses we have on the panel here. They're verified geniuses by myself, so they're going to help us unpack the complicated topic of private equity. My name's Kevin Brett. I'm a partner at KPMG in the Cayman Islands in audit. Also head up our technology and innovation team. So, private credit can mean a whole host of things, right? It's really taken a life of its own. I think you can almost compare it to when you go to the grocery store and you see something and it says it's plant-based. And you're like, okay, cool. Well, that's factually correct, but what is actually in there? So, it can range from things like structured products through to direct lending, asset ABSs, consumer credit, right? So this panel here, hey, great. Cool. Thanks for joining us. Fantastic to see you. There he is. Okay.
Sorry, we were just hanging out in the back. We thought we had some more time. Yeah.
Fair enough. Well, thanks for making it over, gents, and great to see you. So we were just talking a little bit about private credit and that it covers a broad landscape. And the three themes we're really going to unpack today is we want to understand from each of your perspectives, where do you see the opportunities as it relates to private credit? Which field are you playing in the private credit? We're very lucky to have both sides of Axonic here. We've got the restaurant and the butcher here, both on the capital side and on the insurance side. I think it's a very interesting dynamic to unpack, and that'll be the second trend we're going to go through. And each of the panelists, I think, have good touch points from the insurance side, and then we're going to round out the discussion a little bit on the risk side. I think there's been some murmurs around what people are seeing in private credit. The governor of the Bank of England had some murmurs, so very interesting to see what you're all seeing on the private credit side. If you can see anything that would enlighten the audience and give us a good flavor of where we're heading in the next couple of years. So first of all, Peter, to you as Axonic head of research, you see a lot, you've done a lot. Tell us what you're seeing in the private credit space, and then also just tell us a little bit of the genesis story of Axonic Insurance. It'd be great to hear a bit more about that.
Sure, thank you, Kevin. As you said, there are many flavors of private credit, and making the press recently was the Blue Owl Meta deal, $27 billion, 148 transaction, which I think goes to show you that the larger private credit shops are looking for larger chunks because, frankly, private credit spreads have tightened quite a bit. And while you can still get in middle market lending a reasonable spread, in the larger transactions, it's very tough. And so what we've chosen to do at Axonic is try to tailor our private credit offering to market need. As everyone on this panel certainly knows, regional banks have largely exited certain parts of the lending market after the mini crisis, if you will, that occurred at the end of 2022 and early 2023. And so we've stepped into several, I call them buckets. That we have a middle market asset-backed lending business. We have a specialty lending business, which is a bridge financing business of the monetization of IP assets, for example. And I think a particularly interesting and attractive business, which we called our private investment liquidity solutions business, which are loans we make from, let's call it $5 to $50 million, to usually to wealthy individuals that have investments in private equity funds. As we all know, the DPI ratio, that is distributions to paid in capital ratio, has fallen quite a bit. If you look at the 2018 vintage of private equity funds, that ratio is at about 0.6. Down from about 0.8, meaning that private equity funds are taking longer and longer to make distributions. And so one of the areas of opportunity we see that doesn't compete with the larger private equity allocators of capital is to provide bridge loans for those individuals looking for liquidity prior to the final distribution. And I think with that, maybe I'll tee up my colleague, Sulexan here. In addition, Axonic has been fortunate to build an organic insurance business over the past 3 years. It was just in the press recently. We received a $210 million private equity investment from a well-known PE shop. And our insurance business, is writing annuities at about $200 to $300 million a month. So AUM for that business is growing. We're retaining a lot of that capital. And Sulexan is part of the team that absorbs, if you will, or cuts up the meat that my team is serving up in private credit.
Wow, fantastic. It sounds like it's been really, really successful. But yeah, over to you, Sulexan. Tell us all about the story so far.
Yeah, I think an important statistic maybe to share is there are 4 million Americans retiring every year and will retire every year through 2027. So that's 10 to 11,000 Americans per day retiring. So if each of those, let's say, invest in Mago or a fixed index annuity at 100,000, that's $400 billion that are going to be entering insurance capital coffers every year for the next 3 years. So there's an incredible rush from established players, from new players to go after that retirement capital, particularly as these younger boomers don't have savings like the older boomers have. There's an incredible rush to focus on that sector, and that's sort of the genesis behind Axonic Insurance. We have a senior management team that's incredibly experienced. We're led by Michael Gordon, who has heritage, going back decades, even in his family, working at insurance companies, and just put together a great team to focus on that sector. We operate more like a mutual than I'd say a sponsor-backed insurance company. We're, pretty conservative with our investment portfolio. We have a significant allocation to private credit because that just makes sense where the yields are and given the compression and publics, as my colleague mentioned. And so, we've done incredibly well. We've written $2 billion in annuities in the last 18 months. It's just, good distribution, good sales, good operations, all of that's homegrown, which again are very different from other sponsor-backed insurance companies. And so, the demographics are just playing in our favor, as well as, assembling a team to kind of go after that market. And we just raised $210 million, and we put out a press release regarding that. So, we think that the insurance sector, there's a lot of, the pie continues to grow as more and more retirees come into the pipeline. And that's just one of the sectors that we're focusing on. So yeah.
Brilliant. I mean, it sounds like congratulations on what sounds like a very positive journey. And I guess in terms of what is the key differentiator between what you're doing at Axonic versus, Apollo's Athena or KKR's General Atlantic?
Yeah, I think we're focused more on a particular subsegment of the market. We don't reinsure. We don't buy blocks from other companies, which I think a lot of what you see in the space is that other competitors are more focused on sort of the reinsurance as an element to grow their investor base, their insurance base rather. We're focused on sort of organic growth. We have 5,000 agents that we have signed up. We have distribution channels through banks, broker dealers, high net worth individuals. So we have a multifaceted approach, which I think is a little different from, again, sponsor-backed, where I think they are more focused on asset gathering, really to feed sort of the investment management business and Apollo. That's just not in the DNA of Axonic Insurance.
Great, thanks for that. And over to you, Rich. From an allocator's perspective, right, where 10-year Treasury yields are at 4.5%, what is going through your minds when you look at private credit? Are you looking at insurance as well? Yeah, tell us a little about how you're looking at things at Franklin Templeton.
So I'm just back from a week in the Middle East and attending the Future Investment Initiative Conference, and the top 30 or so sovereign wealth fund and other investors there, just kind of quickly adding them up, represent more than 6 trillion AUM. I think Sulexan's already talked to the demand for private credit amongst insurers, which is very solid. But for many other types of investors and allocators, the demand for private credit is very strong, to the point where at that conference, anybody AI related was a rock star. But the private credit PMs were also rock stars, and they were very puzzled by that. One guy said,
"Oh yeah, they were.
I've been boring for 30 years, and now I feel like Brad Pitt at this conference." And if you look back the last 15 years, it's no surprise, private credit, 4 major flavors, 19 different sub-asset classes, has provided actual returns above equities with less observed volatility than bonds or cash. So the math has been too good to be true. We don't get to buy the past, we have to buy going forward, and yields have come in. But still, whether an investor is looking for return enhancement, diversification, inflation hedging that's not strictly CPI, but something broader and more real, different flavors of private credit offer different combination of those things. And I think it's a case of innovation in the real economy, innovation in the capital markets, rewarding investors that were willing to do something new, something without an established track record. If we go back 15 years, private credit was distressed debt and mezzanine lending. And those are still important sub-asset classes, but not the main show, not the most interesting show, and not the areas that have the highest yields. So I think allocator demand remains very strong, despite yields having come in as private credits become more acceptable to many types of investors.
And is there a specific type of private credit that you're more focused on the other than the other, or certain types of private credit you just won't look at, or give us a little bit of a flavor of where do you kind of like to play?
It differs by client, but we see the biggest opportunities kind of in general in asset-based lending, asset-based finance, regulatory capital relief, anything to do with helping private equity investors get liquidity, which I think these guys have already spoken to, sort of areas of capital markets where banks have been pushed out by regulation and capital market participants really want to do something and they're willing to pay something to somebody to get that done, not on their own balance sheet, but on somebody else's balance sheet. So there's plenty of demand for other types of private credit, but those are the areas where the math and the allocation models, you're getting the free ride of diversification benefit with return enhancement and volatility reduction at the total portfolio level. I think there's a lot of concern about where we'll see a bubble in private credit. Even if you look at the 2020 vintage year, when interest rates were zero and we were throwing helicopter money at the economy and just lending standards went out the window, and then 14 months later we had short-term interest rates of 5%. So think about that shock. We had a vintage year where we had the most liberal policies in the history in terms of monetary and fiscal authorities, and then we went to the most stringent with 9.1% inflation. We went to the most stringent monetary conditions we've seen in recent history within the space of a year. We've only had about 1% of direct lending go to non-accrual in the subsequent 5 years. And that's on a yield premium that was started at 500 basis points and went up to 1,000 basis points. So even if all those loans turn out to be 100% loss, it's not a big haircut against the yield premiums that we got back then. That's a pretty big acid test for private credit, and yet we're not seeing signs of a bubble yet come through.
Very, very interesting. So, JC, switching it up to yourself. I'm not going to try to say your name. I'm not so brave, but it sounds like a very awesome French name. I'm not French, obviously, so I know there's a lot of harsh critics here, so I'm not going to try it. But, JC, you're doing some exciting stuff at Lighthouse, some fintech, consumer credit focused strategies. So, please break it down for us. Let us know how that works. And,
No, the space is really exciting. And I think what my fellow colleagues have said, not all private credits are set up the same way. We're really narrow focused. What we're looking at is really just the consumer lending space, really where the fintechs have really evolved. And I would say we're probably in the second inning of how that's going to materialize in the future. Outside of the US, most people, when they borrow money, they're not going to traditional banks. They're using their phone and they're going to somebody electronically to get that cash that they need. And so we just see that as a bit of a tailwind, and it's growing exponentially just here in the States. You think about 2021, this space was probably around 200 billion. Today, to 2025, it's probably close to 300 billion in consumer loans. And we're estimating about 2030, about 400 billion. So there's that tailwind that's going after specifically the consumer side of this private credit world, and the yields are a little bit higher, and there's a reason behind that. It's a pretty decentralized structure today. You have on the far end, you have some players that are doing multi-billion-dollar loans, like the SoFis that everybody knows, and then you have about 250 of these smaller players that are doing anywhere between $50 to $500 million of consumer loans on an annual basis. And I think that's really where we're focusing on. We think that this is going to be the sweet spot. This is where the IRRs are going to be a lot higher. We think that we built a bit of an interesting mousetrap. We partnered up with a bank that is an originating bank. And so as the loans need to be originated through an actual bank, because at the end of the day, the fintech lending platforms, they're great. They're great at finding consumers. They're good at building GUIs, so attracting talent, the consumers. But what are they terrible at? They're terrible at banking regulations, and they're terrible at finding somebody to offload those loans to. Ultimately, they're asset-based. They don't have assets to hold that back, so they have to push those loans out to somebody. Now, that's where I think we built a nice little different mousetrap where our originating bank today knows those loans. They have to underwrite it from a banking regulatory standpoint. And then we're also helping them on the offloading, creating a vehicle that will be able to kind of take some of the loans that we like and put it into a fund structure that then we can make it available to some of our clients.
Awesome. Thanks, JC. Sounds very, very interesting. And thanks for peeling away the layers on that to make it understandable to all of us. Akhil, over to you as the emerging manager, right? So you must have seen a gap in the market. You just started up recently. Last year, I think, January, you kicked things off. So yeah, tell us a little bit about what you're seeing out there, where the opportunities for you, given you started your new product. And then also tell us whether or not insurance has also had an impact on your fundraising and how you see that moving throughout the industry going forward.
Yeah, absolutely. So I'm the founder and managing partner at Indago Capital. As you mentioned, we're relatively new. We started in 2023. And my background prior to this was I ran the structured products business globally at 𝐏𝐫𝐢𝐯𝐚, and a pretty broad mandate looking across a variety of sectors within specifically asset-based finance. So just as how we look at the opportunity set, private credit is a broad term, but from an allocator perspective, where the market first developed was really more on the corporate direct lending side. The asset-based finance market is today, I think, where the corporate direct lending market was maybe 5 to 7 years ago, where it's still a fairly niche space. You do need specialized expertise, and it's a smaller number of players that can attack that market. Our unique angle, or really why I wanted to start Indago, was we saw an opportunity, especially in the middle markets within asset-based finance, where as some of these transaction sizes get bigger, whether it's the large Blue Owl deal that was referenced or some of the larger transactions, the minute that you can take some of these assets and then securitize them in the and securities market, or very often now, a big theme that we'll talk about today is insurance capital. What has been driving the market to a large extent is taking, whether it's pools of consumer loans, pools of mortgages, and fitting them into insurance company balance sheets in fairly capital efficient manners. That's really been the driving force of the market. Where we think we have a unique advantage, or where we're focused, is in the middle markets, defined as the part of the market where the aggregate assets are less than a couple of $100 million in size, maybe similar to some of the niche strategies that JC talked about. And as soon as you look at that segment of the market, the capital that a lot of these specialty finance businesses have available to them is just a lot less efficient. Those assets typically can't be securitized, can't be put into insurance company balance sheets, largely on account of size. We do have somewhat of a similar perspective where we sit in the middle of both insurance capital and more opportunistic capital. Our seed investor is a domestically licensed life and annuities player in the US. And as a part of that transaction, we manage long-dated capital for them across 2 different mandates. One of them is similar to the Axonic insurance business, where we're generally looking at higher up the capital structure, predominantly investment grade type risk. And then that sits alongside our more opportunistic credit vehicles. I think what that really creates for us is it gives us a breadth of capital with which we can provide solutions to our specialty finance counterparts up and down the capital structure. That does create a sourcing advantage, and really what we're looking to compete on is just ease of execution, certainty of execution, flexibility of capital, being able to provide solutions up and down the capital structure. Our remit's pretty broad. So while we just focus within asset-based finance, it's a huge market. The total outstanding, depending on how you measure it, is about 10 trillion. And within that, there's a lot of sub-asset types. So there's mortgage finance, both residential and commercial mortgages, various forms of consumer finance, and unsecured consumer lending, credit cards, student loans, autos, parts of the business finance universe, both small business and then the broadly syndicated CLO market, and then other specialty finance assets like equipment leasing. So we look across this breadth of underlying asset types and look to move capital to where we think the more interesting opportunities exist. And again, given the breadth of the underlying universe, there's a lot of cycles and many cycles that create specific opportunities at different points in time.
Great. I think we've had a lot of good perspectives on where we are, where we're seeing the market now. I want to move into some of the play between the insurance side and private credit. Let's explore that a little bit more. So, Akhil, I mean, your first seed capital is coming from an insurance provider. Can you talk us through, what in your previous life versus, raising from this insurance capital? What is the difference in terms of the conversations you're having when perhaps you're raising from a traditional allocator like Rich versus coming from an insurance provider?
Yeah, I'd say the biggest focus from the insurance side is to maximize the return per unit of risk-based capital. And so very often for insurance businesses, you do tend to run them at a significant cushion versus the required regulatory capital. And so as we're looking to raise capital, whether it's managing for our investment grade sleeve or for the opportunity fund, the idea really is how do we structure these underlying investments to make them capital efficient from an insurance company balance sheet perspective. So I'll give you a couple of examples on both sides. So the investment grade SMA that we manage, it is fairly capital efficient for insurance companies to just own whole mortgage loans, whether it's residential or commercial, because they are generally secured by real estate. So there are a number of mortgage loan-related strategies that do fit that side of the bucket, and typically the return threshold that they're looking for tends to be somewhere in the SOFR plus 300 to 400 type range. Could be tighter than that as well. Alongside that, there's a number of other private credit type facilities that we very often work with the rating agencies to get them rated. So again, they can fit the insurance company balance sheet. On the opportunity fund, and this is a big emerging area for a number of credit managers, the general mechanism for an insurance company to participate, they can participate directly, but there is also a rated feeder structure where instead of owning the underlying fund interest directly on the insurance company balance sheet, that fund interest can be contributed to a special purpose vehicle that then issues notes, the majority of which can be rated investment grade. And that really owning the underlying notes gives them the same look-through exposure to the underlying funds, except they're owning it in a lot more capital efficient manner. So I'd say a lot of the differences come about just trying to solve that capital need.
Yeah, great.
So Akhil made a really good point about the linkage between insurance-based capital and opportunistic capital, and particularly in a rated note structure. One of my pet peeves when I meet with allocators that are not investing in private credit yet is somebody on the committee or a consultant will say something like, well, we need an expected return of X and private credit doesn't offer that expected return. First, that generalizes about a huge range of sub-asset classes, but it also ignores that bottom tranche of a rated note structure where everything that's not investment grade or flowing through as investment grade, all the initial cash flows is left. And that's got a huge expected return to it and diversification potential that meets the needs of opportunistic investors that have equity like or above expected return premium. So if you take one thing away from this panel, I'd say it's that private credit is not one size fits all. And if you hear a generalist statement about private credit, you should get allergic and get a different advisor.
And if I can just add to that, I feel you, because that's what we do every day. So there's a number of things one can do to tailor returns. One is through structure, which Akhil articulated quite well. And the other really is through bespoke solutions based on client needs, because there's a dearth of capital to certain borrowers, both in the middle market space to smaller businesses. If you're talking about borrowers with $50 to $100 million in revenues, for example, on the company side, we have a company ABL business. We're able to get, and we're able to get security on cash, accounts receivable, inventory, all the assets of the company, sometimes with guarantees from the equity, sometimes with PGs from the founders, believe it or not, mid-teens, which is, it's pretty good given the underwriting we do. And we're even able in those situations to get control agreements and have real-time monitoring of bank accounts with account control, with DACAs and all sorts of bells and whistles. And that's really because of the dearth of capital in that space. Similarly, given the sort of voracious appetite for LPs and frankly, sponsors or founders with restricted shares, we're able to tailor bespoke solutions that really serve their needs in terms of duration. We might pick for a little while if they have a liquidity need and they know they're going to get a distribution at a certain period of time. So I think you can also get excess return in private credit, to your point, Rich, because one size does not fit all. And I imagine both JC and Akhil are doing the same thing here. By tailoring the solution to the borrower's need, you can get excess return that you really can't see in the public markets.
Yeah, I think that's a good segue into JC, right? When you're thinking about tailoring products to clients' needs, you don't get more bespoke than consumer credit, right? So are you seeing the same kind of demand for the consumer credit type products? Are you able to get them rated and get them sold to this wave of insurance capital that's coming in?
So we're playing a little bit on the smaller end, right? $100 million forward flow agreement. So I think there is pockets of cash coming through the insurance. There's opportunistic credit bucket that gets bigger and bigger as they fill up all their direct lending. I think there are areas that they're looking. I think we chose to start with the evergreen structure. There was a lot of debate on how we wanted to kind of launch a program. I think the most obvious was a drawdown structure. I think that's what a lot of folks kind of started with. But the more we talked to some of our investors and clients, they really did like the idea of structuring in an evergreen, having somewhat more liquidity, even though it's still tied back to the underlying asset. Now, when we talk about consumer loans, I mean, we're talking about 24 to 24 months, maybe, not that very long as far as they're concerned. And so the evergreen structure really kind of made more sense for us versus maybe the drawdown structure. So it is an exercise of maybe tailoring what you have underneath the cover to maybe the structure that some whether it's an insurance company, whether it's a endowment foundation, whether it's a high net worth individual, what kind of works for them.
Great, thanks. And Sulexan, just bringing you into the conversation, right? When you're looking at placing the capital that you've raised for your insurance side of things, what are your assessments, right? What are you looking at? Is most of the deal flow obviously going to Axonic Capital, or is it also going out to other sectors in the private credit market?
Yeah, I think we're looking at all. I guess we define private credit as broadly as you can. Loans, residential, commercial. We're looking at things like military housing, ag lending. We are partnering with our colleagues on our LP lending and LP solutions. So I think we look very broadly at the space. I think one of the things that we are definitely mindful of is the attention that regulators are paying on the sector, looking at specific rating agencies and not being comfortable with their risk assessments. New regulations coming out to assess risk on things like CLOs versus relying on rating agencies. And so while we have to kind of manage two things, sell the liabilities, sell the annuities, get the capital and invest it, make sure the ALM is matched, but also then focus on the regulator and how they are looking at our asset portfolio beyond just sort of relying on audits, relying on rating agencies. So So it's not just the investment component; it's also the regulatory component, which is one of the things that keeps me up at night. And we definitely seen over the last, call it 18 months, the regulators are quote unquote modernizing their approach to it. Sort of like they're just becoming more attentive to the risk in the sector. I certainly think things like the recent news around HPS and BlackRock's debacle and how that was just kind of rampant fraud doesn't help things, with the space. It certainly puts a cloud in it and puts more pressure on us as insurance company capital managers to make sure we're doing, proper surveillance, underwriting, due diligence, not only of the assets on our balance sheet, but also of the managers managing the assets. So it sort of puts more work on us to make sure that we're, acting as fiduciaries for a policyholder capital, which we would normally do, but then you just have a microscope under you. So I think the regulatory component, as well as sort of just, the investment landscape, is two sort of important things that we manage.
And Sulexan, if you don't mind, you mind just breaking it down a little bit on the regulatory side, just so the audience understands a little bit more what you're talking about when you're focusing on what the regulator's looking at from the insurance perspective, and also the need for ratings, right? Rating agencies.
Sure. So when you make an investment into XYZ private credit fund or investment, you have to hold a certain amount of capital. That capital is tied to a rating. So, AA, single A, rating agency rating maps into the NAIC or regulatory level, and then you have to hold a certain percent of capital. If you invest in a AAA and it's really a CCC, you're undercapitalized, which can cause problems for regulatory capital tests, which you have to meet, and you have to certify annually. So being undercapitalized is obviously a terrible thing and get taken over. There's reputational risk. You have to see the book. I mean, it's sort of like a nightmare to deal with. And even if you're approaching certain action level or certain levels of I'll call it over collateralization for simplicity's sake, the regulators can take action. They can take over your company. So managing regulatory capital is an incredibly important thing for insurance companies. Again, you're not just managing the investments, you're managing your regulatory capital. And if the regulators are concerned about anything in your portfolio or your diversification or how you're modeling it or how your ALM, they can come in, ask questions, or potentially be more aggressive. And that's something we are actively managing, as all insurance companies do. But again, there's just that regulatory overhang being a regulated entity that you have to manage. Again, it's just not the investment portfolio, making sure you're doing due diligence. It's sort of managing that regulatory risk, particularly as the regulators in this country become more attentive to risk, particularly in private credit.
Thanks. That was a great explanation. And I guess, flowing from that down to yourself, Peter, and to Akhil, the insurance capital needs to meet all these high regulatory standards. Are you feeling that pinch? Is it increasing in the amount of work that you need to do on your side in order to make sure you're meeting the regulatory requirements?
Well, I'll say it this way. We work hand in glove with our insurance team. We're well aware of their needs, but our underwriting is going to be our underwriting. It's we're extremely diligent, as you can imagine. Not only because our insurance business, which is an affiliate, is consuming our loans, but so I do a number of things. I sit in the office of the CIO. I'm a principal at Axonic. We're structured so that everyone at our firm is levered to the success of every business. And the way we underwrite our loans is, we'll have an origination partner. We have a number of origination partners with forward flow agreements, all the arrangements that are somewhat standard to the private lending business. But we re-underwrite everything we get. We have a team of 34 analysts. We are what I would call, we've worked very hard over the past 4 or 5 years to do a horizontally integrated research effort, meaning that the ABS analyst is talking to the CMBS analyst, is talking to the corporate credit analyst. We're all talking to one another to try to assess what we think the risks are. I also, in the office of the CIO, it's also my job to think about markets and risk, and to try to assess whether or not, First Brands is idiosyncratic or emblematic of something more. And so we're looking at both systemic, sector, as well as company risks. And our underwriting isn't any more rigorous because of regulation, because it would be rigorous anyway, but certainly regulatory oversight of the insurance business assures that we have process and that we obsess about process, both on the investment side as well as on the insurance company side.
Music to my ears as an auditor, I suppose. So that's a nice segue into our last segment. So we spoke about opportunities. We spoke about the insurance and private credit dynamic. We're going to move into, risks and what we see in the market. So JC, I'm going to start off with you. We've heard a lot of rumbles out there in terms of people seeing some cracks in the private credit market. What are you seeing? And how do you determine, what is noise? What is signal? Tell us from your perspective.
Sure. I think it's a good point. If anything, people are somewhat concerned about an upcoming recession, and the first group to get hit would be the consumer. So we're kind of right at the tip of the spear right now, looking at consumers. Now, if you think about who we're partnering up with, is the fintech lenders, and they're using all sorts of different AI tools to be able to monitor, analyze the underlying consumer. Now, we don't rely on their analysis. Obviously, from our perspective, we have to do it from a banking regulatory standpoint, but it is interesting to see how maybe a fintech is analyzing the credits on the underlying consumer versus we could take some of that information and then be able to take our analysis and do the comparison and see, well, are they getting it right or not? Now, as far as what's happening today with the First Brands and the Tricolors, we're not in auto, so that's one of the areas that we're not playing in. But you just have to monitor these things. They can be very isolated, and that's how we're kind of seeing it today. We can also be proactive in the way that we bid on the loans, right? We don't have to just take the loans at the same price. We can take a haircut, buy it at 90 cents on the dollar, and actually build in a bit of a protection behind it. And that's part of the whole risk analysis, right? Or the risk management side of it. What is, you estimate what probability losses would be on a conservative 10 to 15%. And then you could also stress test these portfolios and see, well, what does it look like in a GFC type of scenario where consumers are maybe 30% losses, right? And now you have these parameters that you can analyze on top of all the regular underwriting credit analysis that you do. So we kind of look at a bunch of different, a mosaic approach. But as far as some of the initial things that we've seen so far, it seems like it's been somewhat isolated and in a very individual area.
Yeah, and yourself, Rich, from an allocator's perspective, you're looking at things from a very macro level. Yeah, what are the things you're looking out for?
I think a statement that will prove to be true is we will see cracks in the private credit market in an area where the real economy has a bubble or a crack. So if you want to know where we're going to have a problem in private credit, we need to look at the real economy. We were supposed to have a problem this year with commercial real estate loans because of the wall of maturity. We went from something like $510 billion in loans maturing last year to $650 billion this year. We're in the 11th month of the year, and that problem hasn't come through yet in terms of a wave of defaults or forced selling or other bad things. And the next several years, maturities are actually lower than this year. So there is a sense of all tides lifting all boats in the economy, but the 10-year Treasury is down 50 basis points. Credit spreads have come in. The short-term interest rates are down 100 basis points from the peak. If we were going to see that kind of macro stress in commercial real estate or more broadly, we might have seen it so far. Neither of the two recent bankruptcies in the auto sector actually involved private credit. I think the media jumped to, oh, this is the first sign of a private credit problem. It was actually publicly issued credit and bank loans. But leaving that aside, the auto sector gets a lot of attention because that's usually where we see the first signs of weaknesses in the broad economy. But the broad economy remains pretty strong. We seem to be getting actual productivity gains from the AI investment. And I think the push of private credit into financing consumer expenditure or small and medium business activity, those are big parts of what underlies the thesis of U.S. economic exceptionalism and what's continued U.S. economic strength, despite the shocks of Liberation Day's announcements, a record government closure that continues, and so on. We continue to power through. The S&P 500 is up nearly 17% year to date, and that rising tide continues. And now we've got lower refinancing rates than we did 11 months ago.
So access to cheaper capital, allowing for American entrepreneurship to carry on flourishing. Over to you, Peter.
Yeah, I just wanted to say, I think there's an interesting virtuous feedback cycle here too, because the financial markets, over a career, the financial markets have become more and more important to the real economy. It's almost impossible to separate them. You could argue that private credit has in fact helped forestall that wall of defaults that we were talking about. And so private credit supports the real economy because there's a demand for it. There's only a bubble when there's not a demand for something, right? There's too much supply of something and not enough demand. And in this case, insurance companies and large asset managers have a desire, and others have a need for private credit in their portfolios. And we have a very large real estate business at Axonic, and we are finding opportunities in commercial real estate. It was a baby with the bathwater situation for a while, but we're deploying private credit dollars that clearly have helped to forestall some defaults in the commercial real estate market. And so we're also seeing that, frankly, because when loans reside in the private credit market, if you contrast the actual default rate to the PIK adjusted default rate, the PIK adjusted default rate's probably 5 and change. The actual default rate's something lower than that, 2.5% to 3%. Correct me if I'm wrong. But the reason for that is because the holders of private credit are, generally speaking, very strong hands that can negotiate PIK deals with their borrowers and ride it out. Whereas if they were BSLs or broadly syndicated loan owners, they might not be able to do that because BSLs sit at banks, et cetera. And that has also, I think, helped to forestall the default cycle, which can then sometimes lead to an economic downturn.
Yeah, maybe just to add, just from our perspective, I'll echo a lot of the sentiments from the panel, but there is a lot of different flavors of risk out there. And so if you look at, for example, residential real estate and the type of underwriting and the quality of underwriting there, we think it's still really, really strong. And you see that in both the loan-to-value ratios of the underlying loans, the loss given default being still extremely low, whereas there are other segments of the market, especially if you think of the subprime end of the consumer, where you're starting to see some worsening of performance. So I think as long as you have the ability to not be stuck in one lane and to look across a breadth of sectors, there's always some relative value to be had there. So for example, what we like today is the prime end of the consumer. Very often they tend to be homeowners. They have a low interest mortgage rate where they have low debt service obligations, and that end of the consumer is holding up much better than the subprime. So between all of these markets, you can perform a bunch of relative value, and then maybe just adding on to issues that are more idiosyncratic around tricolor or first brands. I think what we've learned from that exercise is, one, it is a competitive market. There's a lot of capital out there that's chasing these deals, and therefore, maybe in some of these instances, the types of elements of deal structuring as well as the types of diligence that one ought to have had happen maybe were overlooked. And so we're very conscious around being able to make sure that we have the right structures in place. A lot of the transactions that we look at in the middle markets tend to be directly sourced and bilaterally negotiated. We have the ability to structure our own deals. And so whether that is making sure that you have the right security on the underlying collateral, the right cash controls in place to avoid some of the issues that have come up, there is a lot of ability to enforce those protections into the structure.
Akhil flagged the importance of relative value considerations. I think for allocators that are concerned about maybe we're later in the cycle and maybe we should be more careful, having a multi-asset credit manager or an opportunistic manager or special situations manager puts the onus of the sub-allocations onto a professional intermediary that's in the market every day and might be able to get your committee comfortable with continuing to allocate if they're worried about spreads having come in late in the cycle and so on. I want to double down on Peter's comments on the performance of private credit as an intermediation vehicle relative to bank lending. Regulators are keeping an eagle eye on this, but the thesis is that banks weren't the best lenders. Taking depositor money, guaranteed liquid, guaranteed return, perceived as risk-free, and lending that out long, that didn't actually serve us very well through a number of economic recessions. The private credit industry is maximizing economic value of recovery, even in workout situations. The counter argument is we have seen some lender on lender violence recently, and that's catching the eye of regulators because that kind of contradicts the thesis that the workouts would be a bit more normal. The last comment I want to make on regulation, Sulexan walked us through kind of the U.S. insurer environment, or how, we've talked about how rated note structures work. A lot of our European insurance clients wish they had the U.S. regulation. They still can't hold commingled interests and GP intermediated funds in a capital efficient way. There's no equivalent to rated note structures, or those are still cutting edge, bleeding edge, not proven out. The UK government in particular, every time the regulators reach out to me to talk about, well, why can't we get pension funds and insurers to invest more in UK infrastructure, UK private equity? I flag, well, you don't allow rated note structures. How are they going to hold the commingled fund interest? They can't even do the private credit component efficiently. If you expect this to work, you actually have to do the regulation to accommodate the asset class.
Brilliant. So it looks like we've run out of time, and I just want to thank you, gentlemen, for a very, very insightful panel. You've definitely helped peel away some of the complexities around the private credit onion, so really, really appreciate it. So please give these gentlemen a round of applause, and thank you for your time.
Thank you.